joined now by Robert Subbaraman. He's a chief economist for Asia, ex-Japan at Nomura right here in Hong Kong. So a little bit stronger than the average forecast we had here. What do we read into it, really?
I'd say it's a gentle slowdown. I think people were concerned we're going to see a sharp slowdown.
It's not a slowdown. It's going great guns. It's just that we're used to having 12-13%. That's the only difference.
The other thing I'd say is if you look into the number, that's for the whole quarter. If you look at the other data that came out, industrial output actually picked up from about a 13% handle in April and May to over 15% in June. So through that quarter, it does look like activity has maybe picked up towards the end. And
that's going against all the predictions, isn't it? And retail sales, did you break those down as well? Because we had those figures better than expected too.
They were better, though with retail sales I'll be a little bit careful, because one reason it went up so much was because of inflation. And this is nominal. If you adjust it for inflation, it's still pretty flat at around 11%. And that's probably one of my concerns, is there's still not strong evidence of any rebalancing in China. Investment has gone gangbusters this year. The investment GDP ratio is very close now to half of GDP. It's unusual, very unheard of. Consumption still isn't growing faster than investment, and that's a worry further out.
Yeah, how so?
Well, if investment's half of GDP, GDP's about $6 trillion now in China. So if investment, which typically grows 12% per year, if that were to go to zero, and it's half of GDP, that would cut your GDP growth easily in half. So China can't afford anymore for a big investment pullback. And the trouble at the moment is if inflation stays high, doesn't come down quickly, and we do expect one more rate hike before the end of the year, probably in September, the risk of rates going up, at some point there is a risk that investment, which is the most sensitive interest component of GDP to interest rates, actually pulls back more sharply.
Right. Well, so we get another rate hike. Do we get another reserve ratio hike while we're at it, as well as we see some symmetry when it comes to this monetary policy?
Well, you saw the FX reserves data that came out a few days ago, 150 billion increase again in Q2. So, with interest rates at rock bottom in most of the advanced economies, China's still growing at 9% plus. I think the capital inflows are going to still be very strong. And by sticking to trying to control the exchange rate, I think the risk is continued build-up of liquidity problems and more RRR hikes. We have two more over the second half.
Right, so that's before the end of next year. But what are of course, inflation is the thing everybody's worried about. Is that the biggest headwind you see for the Chinese economy?
I think in the near term, yes. I think inflation now 6.4%. I think the risk is everyone's expecting it to come down pretty sharply.
Yeah, everybody thinks it's going to peak in July, August.
Maybe already peaked.
Yeah, and but then you look at the producer price number, and that's of course factory gate prices is telling you pipeline inflation, and that's not looking too clever.
Yeah, so inflation. I think the risk here is inflation starts to come down, but nowhere as quickly as people think. We know that outside food, the core inflation has been steadily creeping up. It's now at 3%. It's the highest since the series began. Wage inflation pressures are building. But here's the other thing. If you're starting to try to rebalance and boost consumption and reduce the investment, that adds to inflation as well. So I think the challenge is to bring inflation back down, back to the 4% level.
That's a target they have, isn't it? Of course, yes. And do you see that happening? I mean, I had a guest on earlier from UBS, and she was saying to me, well, she doesn't expect really any big downturn for the Chinese economy. And what she does anticipate is one perhaps in 2014, because we have a new government, or new administration, and, of course, the honeymoon period may have come to an end at that point, too.
That's true. I think, in the next couple of years, I'd say the challenges facing China have got bigger. You've got the inflation issue, you've got the need to really bring down investment, you've got less surplus rural labour moving to the countryside, so wage pressures are building, and I'd say monetary policy is a bit out of date. Monetary policy is still relying on these administrative, quantitative measures. We talked about RRR. We need to move towards interest rate, market-based measures more quickly. So it's going to be all happening as we move to the transition of fifth generation of leaders. So tricky times ahead.
It's a world in hock right now. The US needs to raise its deficit limits. We've got the European debt contagion at the moment seemingly getting worse, if anything. And local authorities in China owing a truckload to banks. They're $1.7 trillion in debt. How did we get into this, and how does it all play out?
Well, I think the way we got into it was the financial crisis. The private sector was so leveraged, and when the crisis happened, to really avoid a Great Depression, the government had to step in, and it's now built up a lot of debt as well. So, you know, we're looking around the world right now, the US debt crisis, the risk of a sharper slowdown in China, and of course what's happening in Europe and Italy. I think all economists now generally would say the risks, we have a modal forecast most likely, and we're still pretty comfortable for the second half, but there's serious risks that we could have a much harder slowdown in the second half if one of these things really blow up.
Yeah, I mean, that's the thing. I mean, if it goes to Italy, that's, well, that's good night nurse, isn't it, really?
And I think a lot of people don't realize in Asia, if you look at Asian exports to the US and Europe, nearly all countries have a bigger share to Europe now than the US.
Well, the EU is a bigger economy.
And also, you look at the banking sectors, Asia's much more exposed to the Europe banking sector than the US banking sector. So, you know, if
we get an actual blow-up in one of the big Eurozone nations, which of course will have a severe impact on the banking system there in Europe, Asia gets it through that means of, channeling, if you will.
Well, there's three channels. There's that. European banks will probably cut back their credit lines to Asia. There's the export channel, as the big European economy is slow. And there's the financial markets channel. Don't underestimate that. Markets come off, the negative wealth, confidence effects. You know, we've looked through this, and we would say probably in Asia, Hong Kong, Singapore, very open economies, very big financial sectors, they're pretty exposed. But I would say, you know, also looking at Malaysia, Taiwan, Korea.
Well, you're saying everybody, basically, aren't you?
Oh, no.
Not so much China, though.
I didn't say China. So yeah. I'd say, you know, looking at other countries, China, they do another big stimulus. They're a closed economy. Then they're not that exposed. Another interesting one is actually...
They're exposed to exports, though, aren't they? That's the thing.
Well, not that much. It's a share of GDP. It's a big economy, so they export a lot, but domestic demand's huge. So they're not that exposed. Japan's an interesting one. It's also very closed, and because of the earthquake, it's already kicking in a lot of stimulus. There's another big third supplementary budget coming in September. So Japan actually could be relatively one of the least scathed. And then there's also Indonesia, which is closed, lots of room policy response. The good thing for Asia, I would say, is by and large, we have a lot of room to expand fiscal policy, and we have basis points. We can cut interest rates a lot.
Yeah, for what it's worth here as well. But, you know, the chances of this also playing out in the US, that's another, well, I mean, if that happens, I mean, do you think it's just brinkmanship right now? We will get a deal at the end of the day in terms of this deficit limit.
So the base case at Nomura for both this and Europe is actually, the policymakers are eventually going to deliver, because the contagion and the risk of the whole EMU blowing up is just so severe that they're going to come through the goods. But clearly the ball's in their courts. For US as well, a lot of brinksmanship, but at the end of the day, we think a deal will be made before we get to early August. So we're seeing...
Is that dollar positive, though? And if it is, how does that affect things in Asia with so many currencies which are tied to the dollar?
I think, you know, ultimately it could be near-term dollar positive if the debt ceiling, which is obviously a risk weighing on the dollar a little bit. But, you know, longer term here, the problems in Europe and US are not going to go away near term. We have huge fiscal tightening to come, and that means interest rates are going to stay very low in Europe and US. It means, I think, in the longer run, multi-year currency appreciation in Asia. Asia is where these other currencies are going to have to appreciate. The euro, the dollar, the yen, they all are under pressure to weaken. It's who's going to weaken the most.
Yeah.
It's really Asian currencies that will appreciate a lot.